Hello and welcome to our financial management presentation. We are Group 10 and our team includes Hannah, Krunal, Yao, and myself, Ashwarya. Today we will be talking about Polar Sports Inc., which is a fashion ski wear manufacturing company. Their product range includes ski jackets, snow pants, sweaters, accessories, and everything else that you'll need for a snow day. They have premium quality products attributable to their technical and labor intensive process, and these products are popular among both professional and amateur skiers and snowboarders. This is where the case finds Polar. They have a highly seasonal production and sales schedule. Their operations are laid out in such a way that their production is scheduled to match the sales for any given month. We also know that 80% of their sales take place between September and January. And so, given their operation structure, Polar carries out bulk of its production in August and Jan. Polar is now considering moving to a more seasonal production. We also want to highlight the competitive nature of this industry. Skiing and snowboarding apparel have become a growing product category due to a rise in the popularity for these sporting activities. As this market is growing, so is the competition within it. Polar's biggest competitors include North Face, Burton, Carbon, and more, and high-end labels such as Prada and Armani have also entered the market. A high degree of competition has made it difficult for a lot of players to succeed in this space. Which brings us to how Polar Sports Inc. creates value in this market for its owners by designing, manufacturing, and delivering consistently premium products that are loved by their consumers, leading to increased sales and a growing market share. Next, we looked at their success where we looked at two key parameters. The first is the overall sales performance. So Polar has an accelerated growth rate between 7 and 9%, which they hope to increase to 10% by 2012. They also have a stable gross margin across 2009 to 2011, which signals their financial stability. They have been able to grow sales and capture market share year on year because of their unique designs and their robust sales network. Our second parameter is solvency. By the end of 2012, Polar also has an outstanding loan of $826,000 with a covenant that was to not get the outstanding balance of LOC to exceed 667x of accounts receivable and inventory combined. For the year ending 2011, their outstanding balance was 0.12x, significantly lower than the covenant requirement. Additionally, Polar's interest coverage ratios ranges between 11 to 15x, which suggests that there is a lot of cushion for Polar to take on debt. And now I'll be passing it over to Hannah to walk us through our next piece.
Thank you, Ash. The main finance question of the case is whether Polar should switch to level production. This change in operation will impact profitability, risk level, cost structure, and the cash flow or liquidity of the company. In this case, when Polar changes from seasonal to level production, the amount of cash tied to inventory will increase. AR and AP ratios remain the same, so we expect that there will be more cash tied to working capital. However, cost of goods sold ratio decreases from 66% of revenue to 60% of revenue, so we expect a potential increase in cash surplus to mitigate the effect. So in terms of how liquidity can increase profitability, we can say that good liquidity management increase profitability of the company since it offers the potential to lower debt, decrease interest expenses, and even increase interest income when the company has excess cash to invest. It also affects cost of capital of the company because it affects the risk level that investors have about the companies. As explained above, the operation decision to switch to level production will make the company less liquid as there are more inventories during off-peak season instead of cash. However, we expect a potential cost savings. So as you can see that since operational decisions impact liquidity and cost structure of the firm, they affect the firm risk and profitability. These factors then determine the availability of the type of capital available to the firm and the cost of capital. So I will hand over to Yao to talk about the numbers for Polar.
So in order to make the decision of whether to use level production or seasonal production, we need to figure out the annual incremental cash flow impact of level production on each of the three financial metrics: cost savings, revenue, and financing cost. So for cost saving, there's total cost saving of 780K. So this number comes from three sources. First is 600K saving through reduced hiring and training costs. 480K, the second, 480K saving through eliminating overtime premiums and reduction in maintenance cost. And lastly, there are 300K additional storage and handling costs due to increasing average inventory level. So for the revenue impact will, under the case in which those styles and colors produced during the off-peak season turn out to be not appealing during the peak season. This is defined as unfavorable case. This can be calculated as revenue under level production minus revenue under seasonal production. So in terms of impact on revenue, so in this case, we need to know what's the revenue under level production. So in order to know that, first, we need to figure out the probability of unfavorable case. I will denote as P, as well as the peak season revenue figure for unfavorable case, denoted as U, and revenue figure for favorable case, denoted as F. Then the expected revenue during the peak season under level production would be P times U plus 1 minus P times F. Then we can get the revenue impact by subtracting revenue under seasonal production from revenue under level production. The third cash flow impact is the financing cost impact. For this one, I'm going to assume revenue is not impacted. So the revenue will stay the same if we were to use level production. And there will be a cost saving of 3 million. So this 3 million comes from two sources. First, there's expected financing cost decrease during peak season. And the financing cost will remain the same during the off-peak season. So this is due to the better cash flow under level production. Also, number two is the expected financing income will increase for level production compared to seasonal production. So as a result, if we add up those three cost savings, we can get the net cash flow impact from using the level production. So next, I'm going to introduce Cornell for his topic.
So when we look at the role of building relationships with finance providers, banks, trade credits, and other stakeholders of the organization, we have to look at it from all perspectives. And especially in terms of Polar, there is room for improvement in terms of building those relationships. However, when we look at larger firms, for example, they typically have more leverage over smaller firms when it comes to defining trade terms, whether that be trade credits or trade receivables, as larger firms typically have more bargaining power since they would impact the business of smaller firms that they engage with greater than the impact that the smaller firms would have. So for example, Walmart would have significantly more say in their trade terms with their smaller suppliers. In the case of Polar's trade receivables, customers took 60 days to pay for wholesale purchases, and those purchases accounted for 70% of the revenue. If Polar had better relationships, they can influence those wholesalers to cut the 60-day period to 30 or less. This decrease will decrease the average receivable amounts throughout the year. And with the receivable amount decreases, the covenants multiple for their LOC will increase, assuming inventory level and the line of credit remain the same. However, given that cash is more freed up and there will be an increase in cash flows, the need for LOC is lowered as a result. From a trade credit perspective, the account payable is based on a 30-day period payment term for Polar. Building strong relationships with the suppliers of the goods you can have an opportunity to increase the payment terms to 60 days, resulting in an increase in working capital, and as a result, having more cash on hand. There's a risk of creditors becoming unhappy if the payment terms are longer than the industry. And the longer they are, there is a risk of unfavorable relationships. However, there is no impact on the covenants perspective for the trade credit, except the need to use the LOC decreases as cash will increase. Now, when we look at building relationships with banks, it is just as important, as it can also give, there's an opportunity to give better credit terms, such as interest that you pay on the LOC, and will increase potentially increase the amount of credit that the banks can issue for Polar through building of these relationships. Building the relationship with the bank through established credit history will support Polar where they require financing for future capital expenditures to fuel their growth. The financing infused in the business can be used to invest into the business to generate greater cash flows and thus maximizing value for all shareholders involved for Polar. So financing works differently at smaller firms compared to much larger publicly traded firms. And over here, we have broken it down by various parameters from budgeting and approvals all the way to debt versus equity financing and how they differ in each of these parameters. So from the process of budgeting and approvals, larger firms, because they're large in nature, involve several levels of approval and involves many partners. And the probability of having conflict of interest is high in larger firms, and usually the process typically takes longer time because there are more stakeholders involved. In larger firms, the top leaders also need to consider multiple projects and prioritize the one that maximizes shareholders' NPV, their net present value. And in smaller firms, although that is a consideration, there aren't that many projects to consider given the size and scope of their businesses. Now, in larger firms, there's a long history of business and the availability and correctness of financial data. And so therefore, larger firms are assessed as having lower risk. And there's also a factor of established relationships with bankers and investors. So in terms of raising financing, there is a little bit easier than smaller firms, given if the amount is the amount that they're raising. Now, when we look at the cost of capital, larger firms usually have a lower cost of capital given the lower risks associated with the large firm, as they would typically be more diversified in many aspects, whether that be geography, businesses, line of businesses, while smaller firms would be more niche than the large firms, and as a result would be considered more risky given the nature of the business or geographies that they operate in compared to the larger firms. And finally, smaller firms tend to use more equity financing versus debt financing compared to larger firms. And the reason that is because larger firms tend to be financially less risky and have the strong ability for debt repayments than smaller firms do. That's it for our presentation. Thank you for listening.